Share buybacks or share repurchases are purchases made by a company of its own shares. Buybacks are frequently made from the company's existing shareholders, usually at a price close to or higher than the current market price. One of the primary motivations for a company desiring to repurchase its shares is to return excess cash to shareholders, possibly increasing their equity holding in the company. A company may opt to repurchase its shares for a variety of reasons. For example, a firm may choose to repurchase shares to indicate to the market that its stock price is expected to rise, to inflate financial measures measured by the number of shares outstanding, or simply to try to stop a falling stock price. Share buybacks are prevalent in developed capital markets, where they are often issued when a company believes its stock is selling at a considerable discount to its intrinsic value. Because a share buyback decreases the number of outstanding shares, it boosts its earnings per share, EPS. An increase in EPS raises the market value of the remaining stocks. When the buyback transaction is completed, the repurchased stocks are either categorized as treasury shares or annulled. When a company's shares are defined as treasury, the proportion of the company's shares is maintained in the company's treasury and is not available to the public. Share buybacks are not a typical practice in Kenya. Nation Media Group's share buyback is the first since the Companies Act was passed in 2015. The company targeted buying back up to 10% of its stock and launched a buyback from June 28 to September 24, making a total purchase of $17.1 million. The Nation Media Group repurchase is likely to have given other corporations confidence in doing buybacks. Other undervalued businesses with adequate capital are most likely to follow suit. Crown Paints announced its intention to buy back shares in 2017 before regulator restrictions were in place, but cancelled the plan in 2018 when the share price soared. Jubilee Holdings requested its shareholders to alter its articles of association to allow for buybacks. The Capital Markets Authority has established maximum and minimum share repurchase prices in new rules that are consistent with the Companies Act, 2015, which introduced the share buyback option for publicly listed companies. The regulator has set a price cap of 10% over the weighted average price of the shares listed businesses plan to buy back from the market in the month before the resolution. The CMA has also prohibited listed enterprises with negative equity from conducting share buybacks, thus excluding cash-strapped firms from the practice, which is mostly used to remedy the perceived undervaluation of shares. The regulator has determined that directors of firms intending to repurchase shares from the market must verify that their assets match or surpass the liabilities of the listed company. Before getting cleared to buy back shares, a listed firm must establish its capacity to pay its debts as they come due in the ordinary course of business for 12 months, according to the guidelines on buybacks for listed companies. Share buybacks bridge the gap between surplus capital and dividends, allowing the company to contribute more to shareholders while avoiding a trend. Share buybacks are used by corporate management to demonstrate their faith in their firm and to send a strong statement that the stock is undervalued. To motivate shareholders, the company will give a strong price for its shares, giving an appealing offer for those shareholders interested in short-term profits on the share price rather than a long-term hold. The share buyback diminishes shareholders' equity by the equivalent amount on the liabilities section of the balance sheet. Investors who want to know how much a firm has spent on share buybacks may get that information in their quarterly earnings reports. If the company's EPS rises, the price-to-earnings ratio, PE, falls, assuming the stock price remains constant. The value of the shares has not changed mathematically, but the lower PE ratio may make it appear that the share price represents a better deal, making the company more appealing to potential investors. Buybacks may diminish the amount of cash on the balance sheet of a corporation. Since the company's assets have been lowered, the return on assets will have increased. As there is less outstanding stock, the return on equity will grow as well. A share repurchase, on the other hand, might give investors the perception that the firm lacks alternative viable prospects for expansion, which is problematic for investors seeking revenue and profit improvements. A share buyback often communicates to investors that the stock price is expected to rise owing to some favorable reason. However, It is worth mentioning that the company's management may be merely attempting to prevent a decrease in the stock price. As a result, it is critical to analyze a variety of aspects to completely comprehend the ramifications of a share buyback. Things like recent stock price patterns, EPS and CFPS numbers, news bulletins and announcements, and so on can help estimate the stock's most likely reaction to the buyback.